Hey guys, what's up? How's it going? My name is Rob and welcome back to the channel for another video. In today's video, I got a big surprise, a really good video that I put together for you guys. This is going to be a stock market for beginners video completely for Canadians. There's not a lot of content, especially Canadian content, when it comes to the stock market on YouTube, and there's not a lot of beginner friendly content. So I decided to make this video. I originally thought I was gonna make a paid course, but I said, you know what? I said to myself, you know what? Screw that. I'm just gonna release a free course for you guys, and this is just gonna be basically a really fundamental approach to investing, and we're gonna kind of focus this as if you were a complete beginner. So if you're just getting started, if you're brand new to the market, and you want to kind of benefit from stocks, but you find a lot of it is just kind of confusing and just a little bit over your head, then this video is going to definitely help you get started. And this is a big one. This is going to be a long video. I think it's going to kind of finish out at about an hour long, so it's a pretty long course, but I've done my best to kind of keep it as beginner friendly as possible, and I hope you guys enjoy it. So if you guys do enjoy the video, please do me one big favor, and that favor is to give it a thumbs up. I put a lot of work into this video. It took me a long time to get it going, so hopefully you guys like it, and if you do, please like the video and consider subscribing if you guys want to see more content from my channel. So anyways guys, I'm not going to stall too much here. Let's jump inside the video and let's get started. Alright guys, so the first thing we're going to go over really quickly here is going to be a brief little overview of what we'll be covering inside this video, and we got lots to talk about. This is going to be a bit of a long video, so we're going to try to get through the stuff as quickly as possible, and if at any point in time throughout this video you guys get stuck, you don't understand something, feel free to leave a comment and I'll try to get back to you guys as much as possible. And once again, we're trying to approach this from a very basic fundamental section. I've tried to kind of cut out a lot of stuff that you don't really know to get started and just focus on the basics and everything you need to kind of get started with investing from the simplest way possible, so you don't feel overwhelmed and you can just kind of take this knowledge, get started right away, and that's kind of the whole purpose of this video. So we're going to talk about why you should invest in stocks. That's going to be the first thing we're going to talk about, and then we're going to move on and kind of give a brief little overview of how the stock market works. I'll kind of explain really briefly what a stock is exactly. We'll talk about the common types of stocks, and once again, this is just very basic stuff. I've kind of tried to make this not technical at all and just kind of explain it from, in plain English for somebody who has never invested in the stock market before. We're going to talk about risk and what that means with investing. We'll cover some of the common types of investing accounts here that you guys can see in Canada. There's not a lot. There's just going to focus on the most important ones. We're going to talk about brokerages. So there's lots of different places you can buy stocks on. We're going to focus on Wealthsimple because that's the one I use and the one I think is really good for beginners. We'll talk about ETFs, or electronic traded funds, and why they're very beneficial to anybody who invests in stocks. I'll explain the basics of buying a stock. Once again, just very fundamental stuff, and I'll be giving you guys analyze a basic walkthrough of what you might want to look for if you're kind of looking at a stock. I'll give you guys basically how I do my research. We'll give you guys an example, and I'll talk about why you guys shouldn't try to time the market. I'll talk about why you guys need to focus on stock appreciation and dividend growth for good long-term gains. We'll talk really briefly about taxes because it's a bit of a complicated subject, but I'll just give you guys the basic stuff you need to know, and I'll give you guys some good reasons on why you need to start investing ASAP and an actionable basic plan that you guys can use to get started by the time you are done watching this video. So the first thing we want to cover here really quickly is why to invest into stocks. Why do you want to invest into stocks? What's the point of it? How can it benefit you? So there's a lot of different reasons on why you might want to invest in the stock market. And for me, the basic premises of investing came from, I was tired of working the same job over and over again. If you guys don't know, I've spent most of my life making, I would say, a little bit over minimum wage. I worked minimum wage for many years, and over time, as I got older, I worked from home a little bit. I kind of started my own business. I had some success here and there, but it was always up and down, and I always found that it was hard to have consistent growth, in terms of my finances. It was hard to kind of keep things growing over time. So eventually I turned to stocks, and I learned about how I could put my money to work, so that it always felt like I was kind of it feels like I'm going up all the time. Things are getting easier, and that's what stock market investing really helped me out, and I think everybody can benefit from this. So the main thing about stocks, the first thing we're going to talk about, is how you can make good consistent income. The stock market allows you to make income with the money that you have. So you take the money you have, you save it, you put it in the stocks, and then that money will work for you and grow over time. And the cool thing about this is you can make money while you sleep, or you can make money doing other things. So if you work like a full-time job, 10 hours a day or whatever it is, you can only work so much before you kind of burn yourself out. So if you want to make a lot of money, stock marketing kind of investing allows you to kind of get extra hours in the day, if you will, because you could go to your job, you could work your job, you could put your money to work, and that money works for you while you're working, so you can kind of get more done and you can earn more income with that if you want to look at it that way. And the cool thing about it is it's almost 100% passive when you think about it, right? You put the money in, you buy the stock, and then that stock that you buy or those shares that you buy will earn you money until you sell them. So if you buy stocks and you keep them forever, you will earn money off them forever. So I guess it's not 100% passive when you have to actually buy the stock and maybe do a little bit of work depending on the approach you're taking. But once you buy the stock, it is 100% passive. So, and it's pretty much the closest you could get to passive income. So that's why I call it that. And stocks can really make you wealthy over the course of time, no matter who you are. If you're a high income earner, you can become very wealthy really quickly if you get your personal finances in check and you start investing in stocks. If you're kind of a lower income person, a regular kind of guy like me, stock marketing can make you wealthy over time, and depending on how hardcore you want to be with it, it can really change your life really quickly, and you can see some huge results if you stick with it. And I've kind of shown that to you guys. I'm just kind of like your average guy. I work minimum wage, and it doesn't matter how much money you make or what kind of person you are. You can benefit from stocks even if you're not a big money person. Trust me, guys, whatever your goals, your ambitions, however you want to live your life, it's a lot easier to do it if you don't have to think about money. So that's what stock market investing kind of allows you to do. And it's significantly better than putting money into a savings account. And we'll kind of highlight this when we talk about the different accounts like TFSAs and whatnot. A lot of people will focus on savings accounts, and they're beneficial and they can be good, but investing really can take you. You'll see it's significantly better than savings accounts and the little interest rates you'll get from there. And like I already mentioned a couple times already, anyone and everyone, regardless of who you are, where you come from, your age, your income, whatever it is, your philosophy on life, can benefit from investing if you start investing today. So depending on where you are in this video, you might kind of have a general idea of what is a stock market. You might have heard friends talk about, you might have seen it on TV, you see it in movies, people talk about, oh, I gambled all my money away in the stock market. And there's a lot of different things about perceptions about the stock market that I think, they can be true. I mean, you can gamble your money away in the stock market, but I feel like society's kind of, perception or how they view the stock market, they kind of view it like it's only for rich people. You need to have a lot of money, whatever it is. But it's really just a simple thing that I kind of want to kind of clarify some things here, that anybody can get started with the stock market, and it's not gambling, depending on how you do it here. So the stock market is basically a marketplace where people can buy and sell shares or stocks of a company. That's basically all it is, and anybody can do it. And it is a regulated place where everyone can buy and trade stocks, so it's safe, it's secure, you're not being scammed or nothing like that. And the TSX, or the Toronto Stock Exchange, is the Canadian version of the stock market that we're going to focus on. And so if you're Canadian, you come from Canada, you're going to be buying things off the TSX because that's where we can buy and trade stocks in Canada. So if the stock market is a place where you can basically exchange stocks, or a marketplace where you can buy and sell stocks or shares of a stock, what is a stock? So when you buy a stock, you're basically buying a piece of a company. So if we give an example of, let's say Tim Hortons, I'm having a Tim Hortons coffee as I do this video right here, talk about being Canadian, right? So let's say you wanted to buy, you buy a share of Tim Hortons, right? You're buying one share of the stock. You now are owning a piece of the company, and you now have basically a type of ownership of the company, if you will. And each unit of stock that you buy is called a share. So if I bought 50, if I wanted to buy into Tim Hortons stock, I could buy 50 shares of the stock. And we could use this example with TD, like I put here on the slide here. So, and stocks are issued by companies to help raise funds for businesses to operate. So Tim Hortons will be like, you know what, you can buy our stock, and they'll use the money to help raise funds. And there's lots of benefits to owning a stock. Like you can get dividend payments. As the company grows over time, you can make more income. So it's kind of like a mutual exchange where you're helping the company out, but you're also benefiting from the company growth. Like it's kind of like like when somebody puts money into, like, let's say somebody wants to start up a business, and they go to the bank, they take out a loan, and the bank is like, you know what, we'll give you this money if you give us X of your income, kind of thing, and we can have a percentage of your company, whatever. It's not the same thing, but you kind of get the same idea. You're investing into a business for that business to grow over time and provide you with income and stock growth. So that's basically, in a nutshell, in a very simple explanation, what a stock is. And there's lots of different types of stocks. We're going to focus on the most basic one that you're going to see, and this is probably the one that most people are going to see. When you get to dealing with some specific or specialty funds, you'll kind of see some different types of stocks, but we're going to focus on common stocks. So common stocks are the most common ones you'll see on the market, and common stocks, like I mentioned, represent the ownership in the company and the right to like dividend payments or voting rights, and we'll talk about what all those things are later on in the video. But that's kind of common stock type, or common shares are the most common one you're going to see. There's also like preferred shares and whatnot. We're not going to talk about those because they're more like a specialty type of share. Most companies will have a common type of ownership within the company, and there's other different types of stocks like growth stocks. So growth stocks are stocks that you might buy, you know, Microsoft for example, and you make money off the stock price growing. So when you see the graph of that stock, you know, the price of the stock going like that, that's where you're going to get your money from. You might pay like $10 for a stock, but then like 5 years later the stock goes up to be worth $15. Well, now you've made money off that stock, and that's how growth stocks work. Dividend stocks are a little bit different. Now, dividend stocks focus on giving payments to you, and what they'll do is they'll have things called dividend yields, and dividend yields represent how much money you will get. So the way dividend stocks work is if you buy a certain share, or based on how many number of shares you own, the company will pay you a dividend, like they might give you like 0.15 cents or something like that. They might give you 15 cents or 50 cents, whatever it is, kind of thing, per share that you hold. So if you own 50 shares of a company and they give a dividend of 15 cents per share, you'll get 15 cents times 50, and that'll be your regular payment. Some companies that are dividend stocks will pay monthly, some of them will pay quarterly, every couple months, and some of them will pay like once a year kind of thing. It just depends on the stock and the fund. REIT stocks are real estate investment trust funds, and these are basically like if you go down the street and you see like a building complex, or you see a mall or something like that, they might be owned by a REIT company, and you can buy shares of the REIT and you basically gain ownership of whatever real estate platforms they own. And it's kind of like being a landlord or owning something like that, but you don't have to deal with all the landlord stuff. So the REIT stocks are people who want to invest in the real estate, and usually they pay like a monthly dividend, which is kind of like if you know, a mall might be where people pay their monthly rent kind of thing. You get a portion of that income. That's kind of how it works. So REIT stocks are an option for real estate. Bonds are a type of interest, almost like a loan type kind of things. We're not going to talk about bonds too much, but bonds can be a nice little way to add some interest income inside your portfolio. There's government bonds, there's corporate bonds, there's all kinds of different bonds, and they're a nice way to add some balance inside your portfolio if you want more consistency, if you're willing to sacrifice a little bit of yield. But we're not going to focus too much on bonds. It's just an option for you guys. And then we have ETFs, which are electronic traded funds, and these are one of the big things we're going to focus on in this video. And this is one of the best ways to get started with investing, because with ETFs you're buying like a combination of all these different things. ETFs might hold growth stocks, they might hold dividend stocks, they might hold REITs, they might hold bonds, and you can get specific ETFs that are different, specialized in different areas, but we'll talk about that later on. But these are the most common types of stocks you're going to see: growth stocks, dividend stocks, REIT stocks, bonds, or you know. And the growth stocks and dividend stocks, you'll usually see a combination of the two. So a lot of stocks will have dividends and a lot of stocks will grow. So not to be too confusing with that stuff, guys, but that's some of the basic things you're going to see throughout this video. And when it comes to risk inside a portfolio, there's a lot of things to evaluate and a lot of things to think about. I don't like the term risk that they use when it comes to investing in the stock market, because I think it gives people, depending on, like, for risk for me is more associated with the type of stocks you own. So if you own good quality stocks, I don't think there's much risk with those stocks, even though some people might classify them as high risk stocks. So let's kind of talk about this a little bit. So risk is associated with how volatile. And sorry about the spelling mistakes, guys. You'll see some spelling mistakes throughout this video, throughout some of these slides, so just ignore them. Sorry about that. I kind of caught a few myself already. I've kind of tried to put this together really quickly, but it's with how volatile your portfolio can be. So high risk often can mean high reward, but also bigger losses. So think about this, like let's say you invest in a growth-based stock or some stock that can shoot up, but it can also shoot down a lot. So risk is more associated with the fact that you could get big growth over time, but your portfolio can also go down a lot. So this is more associated with some of the growth stocks usually, generally speaking, when people talk about risk. The key to investing correctly is to balance risk and invest in a way that feels right for you. So if you're somebody who doesn't mind your portfolio dipping a lot, or you don't mind, you know, if a pandemic comes and you don't mind your portfolio going super negative, then you might want to take on a higher risk, because kind of the way it works is if there's a chance for, like during a pandemic, your portfolio can go down a lot, well, there's going to be a rebound for that where they can go up a lot too. So risk is kind of like a high reward, But again, it more comes down to the types of stocks you're investing into, and are you comfortable with your portfolio going up and down a lot? Stocks and equities are the riskiest type of asset, but investing in high quality companies is really the key, right? Like, we're investing in good quality companies, and if you do that, there's not really much risk, but you do have to be prepared for the fact that, even if you invest in a good quality company like TD Bank or something like that, there is periods of time where it can dip a lot. During the pandemic, we've seen a huge crash for so many stocks, while some of the more conservative stocks had, less of a dip. But then again, when the rebound happened, in long term, over time, the more riskier assets kind of tend to go up over time. So if you want that good growth, you kind of have to understand that you have to have some type of risk, and all stocks carry some type of risk associated with them. But when it comes to investing, you got to think long term. Like, long term investing is the goal, and that's how you think about risk. So get the idea that you're really investing for the long term here, and bonds and GICs can also be used used to help balance risk in a portfolio, as can cash and savings accounts. I didn't put that in here, but if you have a cash account or a savings account or emergency fund, that can also help balance risk as well. So you can have that emergency money just in case if the pandemic happens. You're like, okay, you know what, I have some money. Or you can also invest in some dividend stocks and stuff like that to kind of help balance that risk, because at least you're getting money over time. So there's a lot of different ways to look at it, but that's basically how risk works. And when it comes to the types of investing accounts in Canada, there's three main ones you really want to focus on. The first one is the TFSA, which is the most important account in my opinion, and that's the tax-free savings account. Everything that you invest inside a tax-free savings account is 100% tax-free. And that is why it's such a big account. Now, there is an exception to this rule, is if you hold foreign stocks inside your TFSA, it will be 15% of the dividends or the interest income will be taxed. And this could be a lot or it could be little depending on the stocks you own. And the basic premises is keep the growth stocks. If they're foreign inside your TFSA, you can put Canadian stocks inside your TFSA. Everything will be 100% tax-free. And the TFSA is definitely the kind of account you want to get started with. Now, the TFSA is important to understand because there is contribution rules. So make sure you research it. Make sure you find out your contribution limits, because you're only allowed a certain amount of money based on your age, how much you can put into a TFSA. Like, the government, they want to limit this so you can't just get 100% tax-free income, right? But you can take advantage of it, because depending on how old you are, you can have pretty significant contribution room, and anything you make inside a TFSA is 100% tax-free and can keep compounding growing. So dividends, capital gains, they don't count as contribution room. So you can eventually grow that TFSA to be a pretty big account over time. So once again, we'll talk about some more of the optimal ways of doing this throughout the video. But the TFSA is probably one of the best accounts to have, specifically for growth-based foreign stocks and growth-based and dividend-based Canadian stocks. So just kind of keep that in mind. I know a lot of this might be confusing for you guys, but the TFSA is definitely something you want to focus on and look at first. Next up, you might look at the RRSP, which is the Registered Retirement Savings Plan. This is more important for high income earners and for more people who are planning for retirement. So if you're kind of have the TFSA all maxed out, or you're kind of got that under control, you might look at the RRSP. But keep in mind, the RRSP is not, although it does have tax benefits, it's not 100% tax free. Basically, you're taking money that you would be taxed on now, you're putting it into an account, you're allowing it to grow, and then when you get into a retirement, you'll take it out and it'll be taxed on, you basically get taxed on that income then. So it can be beneficial, but it does have a lot more limitations, and it's not tax-free like the TFSA is, but it's definitely something to look at for high-income earners. If you're a low-income earner like myself, I personally don't feel like there's that much benefit, especially since I have to wait for retirement. But nonetheless, it's still important to look at it, because just putting a couple $1,000 a year into RSP to get some benefit can definitely be important as you get older and whatnot. And then last but not least, we have the personal account, which is just your standard Canadian investing account. This account does get taxed 100% on everything. So capital gains are going to be taxed, dividends are going to be taxed. The only caveat to this rule is Canadian dividend stocks have tax benefits. And once again, this stuff can be really confusing. It can kind of feel like there's too much stuff to learn. So that's why I'm trying to keep this as simple as possible. Focus on the TFSA. You can always change things later on. So if you figure out, you know what, I don't want to hold these stocks inside my TFSA, you can always move them out. You can always adjust things as you get more familiar. And if you're going to start out small and just kind of, with a little bits of money, which is what I recommend you guys do, it's not a big deal if you kind of accidentally put something in your personal account that you're not supposed to. It's not the end of the world. The biggest benefit you're going to get is you just get started with investing right away. So once again, it can be super confusing, but just focus on the TFSA, focus on the RSP second, then focus on the personal account third, and you'll be doing fine. So with all that basic stuff kind of out of the way, now we're going to start focusing on some things you can actually do. Now, one of the main things you're going to have to look at is where to buy and sell stocks online. Like, how do you get started with buying stocks? How do you get started, kind of thing. And the good thing nowadays is it's very easy to get started with buying stocks. And I'm thankful for this, that we live in this day and age where the internet and technology has made our lives easier, because traditionally, it was very overwhelming to buy stocks because you would have to go to a bank, you'd have to do a bunch of stuff, you'd have to meet with somebody, and it was really technical and confusing kind of thing. But now we have lots of good brokerages that are online, like Wealthsimple, Questrade, some of the big banks even have them, where you can set up an account and get started trading right away. Now, inside this video, we're going to be focusing on Wealthsimple Trade because I think that's one of the best platforms for beginners. I've done tons of videos, tons of reviews about Wealthsimple Trade and Invest. Check that out if you guys want to kind of explore that more. But Wealthsimple Trade / Wealthsimple Invest is great for beginners. They offer low fees and it's very easy to get started with. And here's the most important thing for me is that there is no account minimum. So it doesn't matter who you are. You know, if you have 10 bucks at the end of the day sitting in your bank, you're like, you know what, I want to get started with investing. You can do that. You can take 10 bucks, you can open up an account. Might take you like 10-15 minutes to open up an account. That's just got to verify some personal information and you can literally get started right away. It's as simple as that. You link your bank account. It's super easy to get started with. So this is why I recommend it. And there is no fees for Wealthsimple Trade if you buy Canadian stocks. And we'll once again talk about that later on. So if you guys do want to get started and you guys want to help me out here, there is links in the description of this video. There's some promo offers. I think the promo offer for Wealthsimple Trade is if you sign up for a new account and you deposit $100, you get 2 free stocks. So check that one out. And I think the Wealthsimple Invest one is if you sign up for an account using one of the links in the description of the video and you deposit $500, I think you get 50 bucks for free or something like that. So check those promos out because it's free money. If you're going to make an account, you might as well get them, and it does help me out. So I do appreciate that. So definitely check those out, guys, if you want to get started with it. Alright guys, what's up? So in this part of the video, I'm going to be giving you guys a quick little walkthrough of Wealthsimple. We'll start with Wealthsimple Invest and we'll talk about Wealthsimple Trade. And I'll kind of clarify the two differences between the two different programs. They're essentially from the same company. Wealthsimple Invest is what I got pulled up here on the screen right now, is the Robo Advisor, and then Wealthsimple Trade is the platform you can use to buy and sell stocks if you want to kind of go down that route. Now, we haven't talked too much about Robo Advisors yet, but I'm just going to give you guys a quick little overview. So the Robo Advisor basically is a platform that basically invests the money for you, and this is a great option for anybody who doesn't want to do technical, understand the technical mumbo jumbo of, picking your own stocks or your own ETFs and whatnot. And it's a very good Robo Advisor. It's very low fee, and I've used it pretty good in the past. I first started this Robo Advisor investing with it back in 2019, and the portfolio since then is up $11,371. So it's a great way to generate passive income if you don't want to get too technical with stocks or you don't want to manage your own portfolio. You literally just click a button and you put it in. And the platform is very intuitive. It's very easy, as you guys can see. Setting up account is super simple. You can have a TFSA, or you can have a personal account and a bounce, or a I think there's some other options too, and an RSP as well. So there's a bunch of different account options you guys can open, and they do a risk assessment. So at the start, they'll ask you, how are you comfortable? And we talked about risk earlier. Like, are you comfortable with your portfolio going up and down? Are you comfortable? Do you want more fixed income? And they'll kind of pick the stocks or the ETFs based on kind of what your assessment is. And they do diversify very well. So it's a very good long-term plan. So the Wealthsimple Invest account is definitely something you can do. If we click over to the left here, we can switch between all the different accounts here. So it can be confusing with the different services that Wealthsimple offers, but you can easily kind of navigate between them all with just the same account. So you just only have to set up one account, and then they'll have these different options here. So if we go over to the trade account, like I will do now, we can now see my Wealthsimple Trade account, and this is where you can buy and sell and do your own trading. So if that kind of interests you guys, like it does for me, then you can definitely take that route. And here's my Wealthsimple Trade account. So it's telling me we have our balance up here, we have our different accounts here. So I have a TFSA on here as well, and I have a personal account, and there is a crypto as well. I'm not going to talk about crypto because I think that's something else. That's not something we're going to focus on at all, but you can go down that route if you desire that. But it's a very easy platform. Oh, and by the way, I am using the desktop app. There's a mobile app as well. It might be a little bit different if you guys use the mobile app, but more or less the same things going to apply here. I use use the desktop version because it's very easy. It's way faster, and for doing these videos, it makes a lot more sense. So if you go inside the TFSA, for example, we can do things such as we can search for a stock here. So let's say we wanted to look at TD Bank stock. So I could type in TD, and it would show me some different options here. So TD, if you know the ticker, you can type the ticker in. If you know the name, you can type the name in. And you just pick the one, and you can always double check on Google if you're not sure what the ticker is. It's important to make sure you get them right. So I'd click here, I'd go to the stock itself, and you can check out some information like how it's performed over the past couple years and whatnot. And you can buy and sell, literally a click of a button. You can click how many shares you want, and it puts in your account. And here on the bottom here, it shows your actual holdings of the particular stock. So once again, this is very simple stuff. Here's the total of the portfolio. We can see a graph of, you know, how it's grown over time. So the past week, the past month, the past 3 months, the past year, and then all time since we first started investing. This is an account I created in the beginning of 2020, and I've just been aggressively growing this dividend growth based portfolio, which focuses on Canadian stocks and US stocks, and it's done quite well for me. And if we scroll down here, once again, we can see our total here, and these are the different stocks inside the portfolio. So very, very easy to use interface, very simple. We can see each individual stock. So here's the stock name, here's the stock ticker that you can find it if you want to look it up. Here's the price of the current stock, and here's the value as long as with your shares, and then here's the all-time return. So you know, since I first started buying Algonquin Power and Utilities, I own 50 shares, total value at $996, and my total return as of today for this one particular stock is negative 9.96%. And you can just look at all the different stocks here inside the portfolio. So it's a very, very easy, basic interface for buying and selling stocks, and I highly recommend it for any of you guys who are just starting out. So it's a quick little walkthrough. I just want to show you guys how to get started with that, and if you guys want to learn more about how to use Wealthsimple Trade and whatnot, check out my other videos. I mean, I post weekly updates on my channel where I show you guys what stocks I'm buying and whatnot, and I give portfolio updates. So check out those videos if you guys want more tips on using it. But let's jump back inside the what we were talking about earlier, and let's expand upon that. Alright, so we did a quick little walkthrough of Wealthsimple Invest and Wealthsimple Trade to give you guys more of a hands-on approach to show you guys. I know we talked a lot about some of the technical aspects of stuff here, and I know it can get a little bit overwhelming, a little bit boring, and hopefully you guys are finding this video interesting as we go through it. But now we're going to talk about ETFs. So electronic traded funds are ETFs, and they're a great option to buy the market and keep things simple yet effective. ETFs are good for beginners as well as experienced investors. I use ETFs inside of my portfolio. I focus on 2 ETFs, one that's Canadian market based and one that's US market based. And you could add foreign ones or an international one if you want as well. Like that's kind of what a lot of people say is, you know, have some types of US stocks, have some type of Canadian stocks, and have some foreign ones if you want them. And ETFs allow you to just, with the click of a button, buy, you know, 50 to 100 stocks just like that. Like, they're really, really good options, and they're a great way to add diversification, like I just mentioned, inside your portfolio. And look for ETFs with long-term growth, and ETF with low fees are preferable. So, you know, you always want to check the long-term growth as long as it's good quality stocks and it's growing over time. And ETF has a low fee, like a low annual fee, it's definitely a good option. And once again, I'll show you guys how to look at some of this stuff as we go later on in this video, but I just want you guys to consider that ETFs, electronic traded funds, index funds, are good options for beginners to get started. And to give you guys a bit more of a guide on how to kind of things to look at when you're buying ETFs, I'm just going to cover one of my most favorite ETFs, and a really, really good solid ETF that you guys can take a peek at is VFE, or the S&P 500 index that's traded in Canadian currency. This is offered by Vanguard, and this is just a quick little snapshot and way how to kind of some things to look at and assess an ETF. So I click on the fact sheet here, the ETF fact sheet, to kind of see some more information about it, and it's going to give us some things such as, I'm just going to kind of go over here really quickly. So let's try the fact sheet. We'll go over here and see if it's something that we can take a peek at. And this is the one we want right here. So this is just a very little quick snap view of the ETF. So we have the name up here, the Vanguard S&P 500 Index ETF. Here we have the objective of the fund, which seeks to track to the extent reasonably possible, before fees and expenses, the performance of a broad US-based index. So this is a US-based index fund. And you can see the ticker symbol here is VFE. It's trading in Canadian currency, which is really important so we don't get charged with any conversion fees. And that's a bit of a more advanced topic, but just keep in mind that if you're trading on a lot of the online brokerages and you're buying stocks, US stocks trading USD, you will sometimes be charged when you convert that Canadian dollars to US. So VFE is a nice option to buy US funds or the S&P 500 without getting charged with that conversion fee. Once again, something to kind of just think about long term. It's trading on the Toronto Stock Exchange, TSX. Here's some facts about the ETF here. The total net assets is $5 million, so you're investing in a lot of different companies. And here's the different performance of the fund. So 2016, the fund got a return of 8.46%, 2017, 13%, 2018, 3%, 2019, 24%, and 2020, 15%. So that kind of gives you an idea of what the returns you can expect. And again, it's kind of up and down, but you're getting an average of a pretty good consistent return. And here we can see over the past 3 years, you would have got an average return of 16% with the fund. Over the past 5 years, you would have an average return of 16%. And since inception, it would have been 18% per year. So you can see these ETFs are pretty solid funds. Keep in mind, the last 10, 15 years have been really good for US stocks. So it's a little bit higher than you know, this isn't an accurate representation of a long history over time. It's probably more closer to 7 to 10% return you can expect. But, you know, recently the US stocks have done really, really well. So that's why it looks really good. But, you know, with this fund, there's a lot of cool things about it. So I'm just going to go over some of the facts here really quickly. I'm going to go back to the other page here so we can see some of the stocks and whatnot. So if we go over here, we can see the number of stocks in the fund. So 507 stocks. So you're buying 507 stocks with the click of a button. Pretty cool, right? And let's go to the region market. Just going to try and find some sectors here. So you're buying stocks in information technology sector, you're buying healthcare, you're buying consumer discretionary, financials, communication services, and all kinds of different things. And here's some of the different holdings. So by buying an ETF, you can get Apple, Microsoft, Amazon, Facebook, Google, Berkshire, Tesla, Nvidia, JP Morgan, like just all kinds of good quality stocks. You don't have to worry about it. Like, all the research and everything is already done for you. And that's why these funds do well. So it's a good option for anybody who's just getting started. So if you want to kind of go down that easy route, especially as you're learning, definitely consider picking up some good solid ETFs. And VFE is a good solid ETF you might want to take a peek at. So again, just to cover really quickly about Robo Advisors, we're going to talk about them a little bit more now. Now, I mentioned that Wealthsimple invest, and also I will say that Questrade and some other programs do have their own Robo Advisors, but I really do recommend Robo Advisors for beginners. So that's the first thing we're going to talk about. And then after this little section of Robo Advisors, I will give you guys some tips on if you want to go down the road of buying and selling your own stocks. But Robo Advisors are perfect for those who are getting started and you don't care to really learn anything about buying and selling stocks, like I mentioned earlier. It's a very easy forget it and let it grow type of investing. All you have to do is put the money in the account, and then the robo-advisor will most likely take that money, put it into some different ETFs like we talked about earlier. And it's important that I wanted to talk about ETFs so you guys can see, kind of just understand how the robo-advisor works. But at the end of the day, you don't have to really do anything, and you'll just pay a small fee for that robo-advisor to do what it does automatically. And it's great to start off with, and you can always switch to a more hands-on approach later on. And this is the cool thing, you know, and I did this myself. I invested with the robo-advisor for 2 years, basically while I was learning about things, getting a better understanding of the stock market. And once I kind of learned how to do things and I figured out the type of portfolio that I wanted, and I could kind of customize and build it myself, that's when I kind of adopted the more hands-on approach. And in the meantime, while I was learning, I gained a lot of money. As you guys seen with the robo-advisor, I made $11,000 while I was learning about investing. So once again, it's a good option. And at the end of the day, Wealthsimple Invest is my recommended robo-advisor if you guys want to get started with a robo-advisor. So at this point in time, if you're in the video and you kind of want to get an idea of buying your own stocks, or if you just kind of want to start learning this stuff and you're going to get started with the robo-advisor, here's the basics of buying your own stocks. And again, this is very fundamentally, we're going to keep this as simple as possible, but this is really a more hands-on approach and takes more work, but can help you customize a portfolio that better suits your needs. And this is what I really recommend. Like, I would recommend you guys, if you guys, you know, want to kind of build a custom-based portfolio or a portfolio that more suits your needs, this kind of suits the person who wants to buy and sell their own stocks. And the reason why I started buying and selling my own stocks is because I wanted a more dividend growth based portfolio. And I needed to kind of build that portfolio myself. So again, I would recommend, if you guys don't really care about investing into ETFs, or if there's specific ETFs you want to invest into, then you might want to build your own portfolio. So in the beginning, like I mentioned, focus on ETFs and build your portfolio around 1 to 3 ETFs, and then start with a small amount of your portfolio to play around with if you want to. And this could be around 10%. So Maybe you buy 1 to 3 ETFs. Maybe you buy like a Canadian market-based ETF of some kind. Maybe you buy a US-based market ETF of some kind. It's up to you on what percentages you guys want. It doesn't really matter. It's up to you. And maybe you'll buy another third ETF. That's whatever you guys want it to be. And then 10% of your portfolio might just be a little bit of money you can play around with individual stocks. And the reason why is because most likely in the beginning, you'll make some mistakes, you'll screw things up, you realize that this isn't the way you want it to do it, and you might want to change things later on. But at least if it's only 10% of your portfolio, you're not going to make any drastic mistakes, and it's not going to affect your portfolio long term kind of thing. And this kind of gives you an idea, like over time, if you do this for a year, you might kind of decide, you know what, I don't want to buy stocks. I tried it, it didn't work for me. I'll just go down the Robo Advisor route, or I'll just stick with ETFs. And then you won't have to sacrifice too much in terms of kind of just learning things in the beginning. And as you learn more and as you grow and as you see results and get a better idea of what you want your portfolio to be, you can adjust and decide what's right for you as time goes on, like I just mentioned. And buying and selling stocks is not right for everybody. It's not the correct approach. And just because you buy your own stocks doesn't mean you will outperform others, or doesn't mean you will even outperform Robo Advisors. In fact, I would say the vast majority of people who buy their own stocks, they underperform like ETFs or Robo Advisors. And the reason why is because nobody can predict the market, and it's just the way things are. And that's why things like ETFs exist. That's why Robo Advisors exist, is because they're great ways to get that consistent yield. And a lot of people think they can beat the market. And like I said, there's nothing wrong with buying your own stocks, but I would approach it more if you want to customize your portfolio and have it better suit your needs. Don't buy and sell your own stocks if you think you can outperform like ETFs or Robo Advisors. That's a bad approach. When we talk about timing the market, I'll kind of share with you guys and explain why. But try to focus on, if you're going to be buying your own stocks, to do it to just kind of customize your portfolio, or you can kind of have a little bit of money to play around with if that's something that you also enjoy as well. So at this part of the video, we're getting more into the technical analysis of picking a stock, if you're kind of looking at a stock to figure out what type of stock to buy. And we're going to keep things fundamentally really simple, really quick. This is just basic stuff. You don't really need to know too much technical financial stuff or whatnot with the way I kind of assess stocks. And I assess stocks in a very basic way. Like I don't dig down too deep. I don't look too much. What I'll do is I'll look at popular stocks. So look at ETFs. And this is a great place to start. If you're looking for some stocks to kind of get started with, check out ETFs. Grab an ETF, to see what the top holdings are, and kind of maybe go through some of those stocks. It's a good way to kind of see, because ETFs already screen their stocks. They're already picking good quality stocks. So you kind of have a good pool to start with. So start with some of the more well-known stocks. Start with some of the stocks that are more invested by different ETFs. And you can kind of dig in them and be like, okay, why are these ETFs holding these stocks? And you can kind of learn over time. But I'm going to share with you guys just some really quick tips, and this is by no means like a 100% thing. Like you always want to do your due diligence, and there's always that risk with investing in individual stocks. So this is just a quick little way to assess the stock. You might want to dig in deeper, depending on what your goals are, what you want to learn, and how all in you want to be with this particular stock. But if you're just doing a quick little assessment, here's what I usually do. So like I mentioned, the first thing is I'll pick stocks that are good quality, well-known names, ones that are popular, ones that are already, people are already recommending. And the one we're going to focus on today is Alimentation Couche-Tard. So this is a consumer-based stock, and it owns a lot of the convenience stores here in Canada, and it's also popular around the world. So this is a well-known company. This is a big company. They've been around for a long time, and the company, as you guys can see here, it says right here, the company has 15,000 stores across Canada, US, Mexico, Ireland, Norway, Sweden, Denmark, a bunch of different countries. Some of them I don't even know how to pronounce. So you can see that the company is well made, it's well diversified, it's global. That's always a good sign. It's expanding internationally, and this looks like a pretty good company. So once again, that's the first thing I look at. Is the company good? Has it been around for a long time? Is it a well-known name? Is it in a good business? And I will tell you that convenience store, that market is a good business. Like we all know, we all use convenience stores. It's all, you can kind of get behind it, right? And the next thing I will look at is the history of the stock over time. And I'm more of a conservative investor. I like growth, I like aggressiveness, and this is a growth-based stock, but I always like to kind of look at a stock that has a fundamentally sound business and is being well managed. And we can see that by a stock that has consistent growth. Now, it doesn't have to be crazy. Stocks are going to go up and down depending on what's going on with the world, right? We know pretty much everything over the past year or so crashed down quite a bit, but that's pretty normal. But when things are booming and things are going good, you kind of want a stock that's progressively rising. And you can see that this happened with Alimentation Couche-Tard. You know, they've had their ups and downs, but more or less, this stock has slowly been rising over time, and we've seen a lot of growth. So once again, you kind of want it as smooth as an upward trend as possible. But like you don't want a stock that's, you know, you've seen ones where it's like a big bell and it's going up and down kind of thing. You don't want ones like that. You want ones that are trending on the high side, just because it just makes sense, right? Like if a stock has done well in the past, it's most likely going to do well in the future. Next thing you can look at is the dividend yield. And some of this stuff is going to change depending on what your goals are. If you're looking for a more dividend-based fund, if you're looking to maybe retire off your money sooner, if you have a large chunk of money and you're older, you might want a higher dividend yield. So for me, I'm younger, I'm 30 years old. I do one day want to live off my dividends or use my dividends as supplemental income, but I don't really care about having super high yield stocks. So this 0.7% dividend yield, which is very low for the stock, doesn't really matter to me. So again, if you're looking for a higher yield, that might be something you want to look for, but this lower yield for me doesn't really matter. I'm more interested in dividend growth, which we're going to talk about later on as well. So after I pick a company that's well known, it's a good quality company, and I've checked its history, and it looked pretty decent. You know, it's got consistent growth. And just so you guys know, if you click on the little buttons here on Google, this is just in Google, I'm searching these stocks. You can see the growth over the past couple of years here. So you can go, the past day growth of ATD is whatever kind of thing. I wouldn't worry about the short term, but you can go 6 months. You can see the stock's up 27%. Really good, right? Year to date, it's up 16%. 1 year, it's up 8%. 5 years, it's up 68%. And max of all time is up 12,000%. So once again, just good consistent growth, as you guys can see. I really want to hammer that in to you guys to understand. And if we go to Yahoo Finance, some other things you want to look at, there's a bunch of different financial stuff you can take a peek at. So you can take a peek at the debt, you can take a peek at the market cap, you can get into that if you want. I tend to not focus on this. I really only want to focus on two things, just when I do a quick little analysis, and that's going to be the revenue, profit revenue. And if there's some numbers up there you can take a peek at, but what I like to do is I just scroll down to the bottom. I take a peek at the annual history of the stock. So what is the revenue and earnings looking back over the past couple years? And you generally want to see a stock, and I'm sorry if I'll zoom up a little bit here. I'm just gonna, hope you guys can see this chart. I'm just gonna move my webcam a little bit to the left here just really quickly. So hopefully you guys can see this chart here. Sorry about that. But you want to look at the annual increase in time. You want the company to be growing, right? And if we go quarterly, we can see how the year has turned out. So once again, we have the tail end of 2020 and the beginning of 2021, and we've seen some increases. Now, some things to keep in mind here, depending on what's going on in the world, you kind of want to factor that in too, because in 2018 we've seen whatever, they have revenue of 51 billion, earnings of 1.6. 2019 we've seen an increase, so that's good news. Now 2020 we've seen a bit of a decrease, and this is kind of normal if you think about it, because it was the pandemic and consumer-based companies took a big hit. So if you see like a consumer, like you got to kind of factor these stuff in when you assess it, and it can make it a little bit tricky. But anything in 2020 probably had a crappy year, and that's expected. What's important is, can they recover going into 2021? And as you guys can see, we're about halfway into 2021, a little bit over halfway, and their revenue and earnings is already almost caught up to 2020. So once again, good signs. Generally speaking, if you can find stocks that it's consistent, that's always better. But again, you have to kind of assess the sectors. You got to assess what's going on in the world. And obviously probably 2020 to 2021 for most stocks is not going to be a good year. Maybe 2021, you kind of want to look for a rebound. And if you see a rebound, that's always good news. But again, it kind of mudds the water when there's different things going on in the world. But once again, you want to kind of see consistent growth, consistent earnings. And to me, that always translates into a business growing, which means a stock will, you'll get a price increases, which will make you more money, and you'll get dividend increases. Now, on the topic of dividend increases, this is a big thing I'm a big fan of. I'm a big fan of dividend growth, and I like companies that are aggressively growing their dividend. And we can see here atd.bu does that, and this is a site that you can use really quickly. Dividend history is a cool little website. You just dividendhistory.org. You can type your stock or symbol up top here. So you can go like atd.bu, and you just pick the one that pops up. And it briefly will show over the past couple years how the stock has been growing their dividends. So in 2016, this company raised their dividend by 15%. 15% growth from dividend. And 2016, at the end of the year, they raised it by 16%. In 2018, they raised it by 11%. 2019, 25%, a quarter of their dividend. these are huge increases, guys. So you can see that I'm a big fan of companies that aggressively grow their dividends, because in the long run, this really makes you a lot of money because it compounds and grows. So I'm always looking for companies that do that. And just to give you guys an example, the average dividend increase is 5 to 10% per year. So because ATD, or Alimentation Couche-Tard, has such a low dividend yield, they can afford to aggressively grow that dividend right now, so we can take advantage of that. And that's one of the big things I always look for. Now, you don't have to look for stocks that have crazy dividend growth like this. Like if you're picking a stock that already has a kind of a well-factored yield already, like if you look at TD Bank stock, they have a yield of like 3 to 4%. You wouldn't expect 20% dividend increases. Maybe like a 7 to 10% range makes more sense for that. So you got to kind of think of the dividend yield in there. But this other website I use called Guru Focus, you can see the 5-year average dividend growth rate, and you can see Alimentation Couche-Tard is at 20%, and the average for most companies is around that 7% range, especially if they have an established yield. So this company is aggressively growing that dividend, and I think it's really in a good spot right now. So again, you kind of want to factor that in there. Most stocks will raise their dividends by 5 to 7% per year. You don't really want companies, if you're going to be investing long term, that aren't increasing their dividends, or they're really increasing that yield at a very small amount, or they're decreasing it. If you see any decreases, anything like that, that's always a red flag. Doesn't mean you can't invest in the stock, you just have to be aware of that. So I always go for the ones that are constantly showing us that they're increasing it over time. And another thing that you can kind of take a peek at to see, like, is this company kind of going to be able to sustain their dividends and whatnot, and are they kind of just doing well from an earnings and financial standpoint? And you can look at the payout ratio. So I'm on Market Beat. This gives us some information about some things are important, some things aren't. But what you want to do is you want to look at the payout ratio, and you can just go to Google and type in ATD.B payout ratio, and it'll pop up there. And you guys can see here that the ATD payout ratio over the past 12 months is 7.94%. So this means that out of the earnings that Alimentation Couche-Tard makes per year, they're only giving 7.94% of that to investors in the form of a dividend. That is next to nothing. So that means they're keeping about 92% of their profit. So you can see that's a very good business model, and that's what allows them to aggressively grow that dividend. Most companies that are sitting around that 40 to 50% range are actually considered good. So once again, a lower payout ratio is always better. A high payout ratio, depending on the stock and the company and the business model, can be okay. But anything like in the 80s, 90s, or over 100 is definitely something you want to kind of just look into a little bit more and just kind of get a better idea of. But generally speaking, the lower the payout ratio, the better it is. And these are some of the basic things I look for. So once again, I know this isn't super technical, this isn't super crazy, but it's just some simple things to look at when you assess a stock. But generally speaking, like I mentioned, look for good quality companies. Check out some ETFs because they've already done research. The stocks wouldn't be in there to begin with if they weren't good quality stocks. And look at some things like I mentioned. Check out the dividend yield, make sure it makes sense for you. Check out the growth. Are you happy with the growth of that stock? Are you happy with the business? Do you like the finances? Do you like the dividend growth? Are you happy with the payout ratio? These are all just some simple things to keep in mind when you're assessing a stock. And just to kind of summarize this for you guys, the fundamentals of a good company include long-term history of consistent stock growth. The longer the better, and the more like consistent is always a good thing. Well-known company that has a good business model, like we mentioned and talked about, has performed well in growth, has performed well in dividend growth. This is optional, but I would highly recommend that you consider that as well, and has a history of a growing business. So earnings are steadily increasing, company is expanding, company is growing generally, and that's always a good thing. And I always like to, this is once again more of a personal thing, but I like companies that have more of a conservative payout ratio. Because in times of pandemics or anything like that, or crises, these are just going to be stocks that are going to do better. And it also guarantees that in the future, like 10, 15 years from now, these companies will still be growing because they just have that more conservative business model. So again, we're thinking about the long term here, and that's the most important thing. Going onwards, if I was to basically summarize this in two simple things, so I know I just talked about a lot of stuff. It was a lot of stuff to learn for you guys. But if I was to kind of drill it down to two things, focus on stock growth plus yield, as in dividend yield. Growth is always important, even for dividend-based stocks. I really want to hammer that in there. Even big dividend-based stocks like the banks and whatnot in Canada, they're called dividend stocks, but they actually have a lot of growth too. And a lot of people who focus on high-yield stocks that don't have growth, they're missing out a lot on just a different area or a different type of earnings when it comes to stocks, but it just, you really are sacrificing a lot long term if you're not to some degree focusing on growth. And dividend stocks do compound and grow over time, but dividend growth is just as important, like I mentioned. So keep that in mind if you are a dividend investor. And if you combine stock growth and dividend growth, you really do get the best of both worlds, like I mentioned. And that's the approach that I take with my portfolio. I want my stocks to grow so that I can get advantage of growth over time, but I also want dividends to grow and that dividend income to kind of give me passive income at the same time. I think they're both valuable. And I think a balanced approach, to some degree, you can kind of go in whatever direction you want, more so. Whatever one you like, but I would say a balanced approach is definitely best in regards to that. Now, moving over here, we're going to talk about why you shouldn't time the market. And there's a lot of studies, a lot of different things. I'm not going to cover them. I'm going to use one example to kind of show you guys. But the reason why you shouldn't time the market is because no one has a crystal ball and can predict if stocks will go up or down on any given day. That is a fact, and you're not smarter than 99% of the regular population. Sorry to break it to you guys, but you're just not. And that's the reason why so many people fail. It's the reason why things like Robo Advisors, ETFs exist, is because it's just, they work better. And I don't know if it's pride or people, watch too many YouTube videos where there's people like, giving all this misinformation about like day trading and stuff and how they made billions of dollars. 99% of the population is going to do that, and long term, just investing in like passive investing will outperform people who day trade anyways. Timing the market can be super stressful and has a history of underperforming long term, like I just mentioned. And focus on time in the market as well. As long as you own shares, you can benefit when a stock or the overall market has positive upswing. So to give the example of this, is during the pandemic, everybody was saying the stocks are crashing, sell your stocks. A lot of people sold their stocks, they panicked, whatever, and even some people were like, well, should we be buying stocks at this time when they were super low? And everybody was like, no, we don't buy stocks, because it's going to dip even further. And guess what happened? We had a mega rebound, and everybody who tried to time the market lost out on a lot of growth. The people who just kept buying day in and day out, they took advantage of the growth, and now their portfolio is doing better than ever. So the stock market is always rising. Don't try to time the market. Just keep buying on a regular basis. Just show up, be consistent, and you will have success, I guarantee you. And like I just mentioned, the previous pandemic is a strong example of this. People are even saying to this day the stock market's going to crash. It's going to go low. Yeah, there might be dips here and there, but just put your money in the market, and if it does go up, or if we do have a really strong year, at least you're going to benefit from that. 2020 everybody thought was going to be a horrible year. It was going to be a negative year, and for some stocks and for some industries it was. But at the end of the day, like if you take a look at US stocks, they were up like 20% at the end of the year. If you wouldn't have invested in the market, you wouldn't have benefited from that. So again, don't try to time the market. It's just super stressful. You're not going to have fun, and you're going to learn the hard way that you're not going to outperform just regular passive investing. Now, one thing we're going to talk about is taxes, and I'm sorry about my webcam, guys. It's probably going to be a little bit of the way here, but I'll talk about this really quickly. So taxes are really simple. I'm not going to get too crazy with them because it can be technical. Just going to keep it really simple here, guys, because everybody's situation is a little bit different. But the TFSA is 100% tax-free for stock growth and dividend yield if it's Canadian stocks. 15% tax on foreign dividends done automatically, so you don't have to worry about it. If you hold US stocks inside your TFSA, the taxes will be taxed before you even get the dividend, so you don't have to do nothing. And this is another thing about the TFSA that's really nice, is if you start with the TFSA, which you should, you don't have to worry anything about taxes. It's already done automatically. It just keeps things really simple. Next up is the RRSP. It's not taxed on foreign income from US stocks, but is taxed when you withdraw. So like I mentioned before, if you have dividend stocks inside the RRSP that are US based, they won't be taxed. But when you withdraw that money, when you retire, that whatever you withdraw will be taxed. So it's kind of like you're delaying the tax, if you will, and letting that money kind of grow in the meantime. But when you eventually do withdraw it into retirement, you're going to be taxed on it. So it's beneficial for high income earners or for anybody who's kind of thinking about the long term. But it's different for everybody's situation, so you definitely want to look into that. And the RSP is not tax-free. A lot of people make kind of mess that up with the TFSA. It's not tax-free. You're just delaying the tax, so keep that in mind. And last but not least, the personal account is taxed on stock growth when you sell. This is called capital gains. And on dividend income, but dividend income that is Canadian based. So if you have Canadian stocks held inside your personal account, there is tax benefits, so definitely look that up. It's a super complicated calculation that you'll do at the end of the year when you file your taxes, but All you got to do is punch some numbers in some boxes, and the government basically does it for you. But just keep in mind, there is a lot of tax benefits for people who do hold Canadian stocks, but the tax benefits don't really happen in the TFSA because it's tax-free anyways. So things to think about, but don't get too complicated with it. When you get to the point where you max out your TFSA and you're kind of getting your RSP kind of filled up, then you can start figuring out this complicated stuff if you guys want. Don't worry about getting too complicated too much. The main important thing is, as your portfolio grows, it's important to learn how to invest in a tax reducing way as possible. And that would be the recommendation I would give to you guys. As you grow, as you learn, as you kind of take advantage of the TFSA and RSP, and you start to dip into the personal account, that's when you can kind of learn about some of the tax benefits. So and it's going to be different based on what your goals are as an investor, right? So that's something to keep in mind as well. And here's the last part of the video that we're going to kind of talk about, is why you need to start investing ASAP. So the main reason why is anyone and everyone can benefit from investing. I was a victim of this too. I was always taught, and always my family never taught me anything about investing. I was never kind of taught this in school or anything like that. And I was always kind of given that, people always kind of painted the picture of investing for only rich people. You need to have money. It's not for regular everyday people, and that was a big misconception. And I wish somebody would have told me that earlier, that anybody can benefit from investing. So it doesn't matter if you work at a grocery store, a gas station, or you're a CEO for some company, you can benefit from investing. I tell you that, it's true. The earlier you get started, the better the results you will get. And this is easy, right? Because money compounds and grows over time. So if you start at a younger age, it's always better. But don't worry if you're 30, 40, 50, 60, you can benefit right away. If you guys have been watching my channel, I've only been investing for a couple years, like 1 to about 3 years. And in the last year, we had a lot of success. So anybody can get started. Anybody can can have benefits, no matter what your age is. And just to kind of a cool little saying to kind of hammer that into your guys' head, is the best time to get started with investing was 5 years ago. It's a nice little quote that people say, should I start investing, or when is the best time to invest? 5 years ago. It means today. Do it today. You're only given a limited amount of time on this earth as you get older. So you may want to spend less time working and more time doing what you want to do with your life. This could be goals, your family, building a family, traveling, spending time with loved ones. If you have hobbies, if you're trying to, cure world hunger, or, cure all disease in the world, whatever it is you want to do kind of thing with your life. If you just want to spend more time with your cats or something like that. Investing and spending less time working and the stress of worrying with your finances will give you free time to do these things. So this is why investing, I think, is really important, and just will make your life 1,000 times easier. Investing will give you peace of mind and get you out of that rat race. Like I said, that if you hate waking up at 6 a.m. or 5 a.m. to go to work and work all day at a job you don't like, you deal with, stressful coworkers, stressful bosses. I've been there for sure. Getting out of that rat race, investing is definitely something that can help you and just make your life easier in so many ways. I cannot stress that enough. And my advice, for anybody who's just starting, is to start off slow and work your way up. There's no rush. There's no, this isn't a race. We're just all at our own pace, working through life and getting there. And investing is the same thing. Everybody goes at their own pace. If you start at it and you be consistent, that's the most important key. And measure your own success. Don't compare yourself to others. Really, really big tip to give you guys. And here's a basic fundamental template to get started right now. My first recommendation would be kind of watch some more videos on YouTube. It doesn't have to be my channel. The fact that you're watching videos and you're learning proves to me that you're taking the required action to get started and progress yourself. So, give yourself a pat on the back. That's a good start. If you're doing that and you're watching this video, that's a good thing. So you don't have to watch my content. You don't have to watch my stuff, but just make sure you're educating yourself and you're learning, and that's a good start. So keep doing that. That's the number one goal. The second thing I recommend you guys to do is learn more about personal finance and start putting some money away to invest. And this can be whatever you want it to be. Being aware of your budget, being aware of how much money you have, it's a good place to start and start getting the habit of saving money, because you need to save money to invest. I would say even saving money is the most important thing if you want to be successful as an investor. And this could be whatever it wants to be. It could be like $10 a week. Let's say you work a job and you're like, hey, I got $20, I got $50 free in my bank account at the end of the month. That works. Start with that and work your way up as you move up in life. And the second tip I would give most people is start with the Robo Advisor account, and every month put whatever money you want and stick with your goal. So like I said, Pick something that's easy in the beginning. Like if you have no money and the idea of saving up $1,000 or $500 just seems too crazy for you, start with something simple. Like every single month or every single paycheck, put $50 away, put $25 away into a Robo Advisor. Make that goal, hit it for a couple months. Then once you hit that goal, challenge yourself. You know what? I hit $50 a month. Let's bump this up a bit. Let's go to $100 and just keep going from there. You know, be reasonable about it, you know, and you have to kind of assess how much money you make and stuff like that. But as you get better at saving, as you become more knowledgeable, as you see your money work for you, this will inspire you and show you and teach you different ways of kind of growing your income and also saving more. So definitely kind of do that. And I highly recommend you guys start with something small and work your way up. And if you do want to start buying your own stocks, open an account on Wealthsimple Trade and look at ETFs to get started with. There's tons of different ETFs. I use VDY, VFV, XIC there's so many different ETFs. Just pick one or two. Make sure it's got good quality stocks, and make sure it's like just your regular everyday ETF. It's not specialized or some fancy thing. Just keep something basic. The S&P 500 is another good example. Just pick something simple, start with that, and go from there. And then, as you learn more, you can expand. And start tracking your results. Dividend income, and have patience. Investing takes time to grow. I started the spreadsheet on this channel where I track my dividend income every single month. I post updates for you guys. I do this for you guys to see it, but I also do it for myself so that I can kind of track my results, and it keeps me inspired and keeps me going, because I can look back and be like, let's say, I've invested for a year and a half and I've hit a bit of a plateau, or let's say I'm having success, but I'm just like, you know what? I don't feel like I'm going anywhere. I can look back at my previous results, be like, you know what? When I first started investing in my first couple months, I was making like a couple bucks, and now I'm making like way more, and I'm having way more success. You can feel good about that. You have to track your results in order to inspire yourself, because sometimes you can lose sight of the big picture, or you can kind of forget, where you've come from, how much, success you've had. You can kind of get used to the new norm. So definitely track your results in some way. It can be by tracking your portfolio growth. It can be tracking your dividend growth, whatever you guys want to do. And continue to learn and grow from a personal finance perspective. And as an investor, your goals and lifestyle needs will change with knowledge as you progress through life. So, your goals, what you want in your portfolio, things will change. So it's important to understand that you might make some mistakes in the beginning. It happens to everybody. Just try your best to learn from them. And if you do that, you guys will have success. I guarantee it. Alright guys, so that's it for the video. So hopefully you guys enjoyed it, and let me know what you guys thought of the video. Leave anything, if you have any questions in the comments, I'll try to answer them as best as possible. If you guys did enjoy the video, be sure to smash the like button and consider subscribing. Take care guys, hope you guys enjoyed the video, and I'll see you guys later.